All right, what's up, guys? Happy Friday. Welcome back to another Dividend Happy Hour, episode number 123. Who said it in the chat here? Let me scroll up a little bit. It was not Pat. I don't think it was. Who was it? I just saw it like a minute ago. Bear with me, guys. I don't see it anymore. Someone said the magic number, angel number, make a. Oh, Pat said that. Patrick said that. Episode 123, make a wish. There we go. But anyway, guys, welcome back to another episode. I hope you all had a great week. I know on the stock market, bittersweet, very bittersweet, right? Let me actually show you guys what's happening in the portfolio real quick. Let's jump over to my dividend portfolio tracking spreadsheet, which of course you can start using for free. There's a link to this bad boy in the description of the video. And I just made a few tweaks to it earlier today. Someone brought it to my attention that some of the formulas were off. The dividends received wasn't loading quite right here on this page. So I went in and fixed that. But anyway, guys, today was a terrible way to close out the week. Down almost $840 just for the day, about 1%. The portfolio value is now just below $86,000. So at this point, I think we're about maybe $3,500 below the all-time high in the portfolio. But it's all good. Like I said earlier, very bittersweet. You know, even though we're losing some money in terms of unrealized gains here, things are getting cheaper. Okay. And there's quite a few good looking deals in the account right now. I mean, just looking over here on my taxable account, let's zoom in a little bit. Just looking at some of these drops today, guys, pretty big. Vici down 2.15%. And I actually took advantage of this bad boy today because yesterday I had a payment come in from Vici, had a payment come in from KRC. And today I got that Altria Group payment. I put all of that into Vici Properties, picked up 5 shares. Earlier this week, picked up a couple shares, I think 2 shares of Realty Income. So we are stacking that cash flow, guys, and we are very quickly approaching $3,100 of projected annual dividend income. And my goal, if you'll remember, by the end of 2025 is to reach $3,600. And at this rate, it's going to be a piece of cake. We're going to get there probably by like June, like halfway through the year. So anyway, very bittersweet, but once again, I hope you guys all had a great week, and I'm sure you guys picked up some nice stocks this week. And before we move on, kind of on that note, grab whatever it is you're sipping on, guys. Let's kick this thing off with a little cheers here. So, crack this thing open here. And cheers, guys. Here's to you guys. Thanks for tuning in and hanging out with me tonight. Episode 123 of the Dividend Happy Hour. This one's going to be a good one. And also got to shout out the mods. We've got Zal, we've got Chris, we've got Matt in the building. Thank you guys all for your help tonight and keeping the chat free of trolls. Knock on wood. Hopefully we don't have too many, but they've been coming in pretty strong. But no doubt you guys will take care of them. But anyway, here's to you guys. Cheers. And also here's to the dividends. Here's to the pursuit of that sweet cash flow, because that's really what's bringing us together tonight. So cheers. Let me know a few things here in the chat, guys. Number one, I kind of asked this a moment ago. Number one, what did you buy this week? I want to know which stocks you picked up. Like I said, I added a little bit of Realty Income, a little bit of Vici Properties, and those kind of have been my go-tos. Those two have been my go-tos so far here in 2025. Really want to start buying some more J&J as well. But I don't know. It's been hard. It's been hard with Vici where it's at. I'm having a hard time putting any money into J&J right now because I just want to put more into Vici. But anyway, let me know what you guys picked up. Number one. Number two, what are you sipping on tonight? What did you bring to drink to the Dividend Happy Hour? I'm sure you guys just saw it, but I got a little Coke Zero. Shout out Shamir, who I don't see in the chat and haven't seen Shamir for a couple weeks. Hope you're doing okay, Shamir. But sipping a little Coke Zero tonight. Needed a little caffeine, I'm not going to lie. Number three, I want to know, did anything cool happen in your guys' portfolio this week? I'm sure we're not going to hear about a lot of all-time highs, but maybe you guys hit some cool dividend income milestones. Maybe you reached 100 shares of SCHD or Realty Income or something else. But yeah, let me know if anything cool that happened to you guys this week on the market. And also, number four, I want to know if we have any first-timers here in the live stream. Let us know in the chat here if this is your first time tuning into the Dividend Happy Hour. In case it is, we do this live stream every Friday night, typically starting at 5 p.m. Pacific time, 8 p.m. Eastern time. This is basically this time every single week. And this is actually like the first time in a while we've adhered to the regular schedule. With the holidays, you know how it can be. It for me personally, it definitely threw me for a loop. But I'm glad to be back on our normal schedule. And yeah, so let me know those few things. Let me scroll through the chat here and see who all we got in the building. I'm going to scroll up to the tippy top here. Looks like I see B Still. I see Chris, Fast Eddie, Zal, of course, Matt, 38 Too Late. What's happening? Salvatore. Good to see you, my friend. Pat from Florida. What's up, Pat? Michael's here. What's going on, Michael? Let's see. RB shows, Coney Dividend. Okay. Suzuki Man, what's happening? Jay is here. What do you say here? Jay said, very cool. There we go. Nice little portfolio milestone. 7,500 in the portfolio and 53 shares of Vici. Very nice. Did you wait? So is this 53 shares? Was that purchased today? Or are you saying that, excuse me, your average cost, you have 53 shares total and your average cost is 28? Because if you bought 53 shares today, good for you, Jay. That's a big buy. But anyway, who else we got here? Pat sold out of Agree Realty. Pat, let us know what happened there. What was the reason for the sell? You can give us the Spark Notes version, obviously. So why'd you sell, and what are you planning to do, or what have you done with the money? How are you reinvesting that? I'm definitely curious to know. That's a big move there. Let's see. Nort here. What's going on, Nort? Alex is here with a nice little shopping spree. Realty Income, J&J, Altria, and SCHD. Nice. Great combo there. Steven, first time watching live. What's happening? What's up, Steven? Happy to have you in the stream. Hope you enjoy the Dividend Happy Hour. Like I said, we do this every single week. So I hope you enjoy this one and hope to see you back next week. Next week, guys. Yeah, next week. I'll be here next week. I was thinking, I know I have something going on next Friday. So, but this is what it is. Next Friday, I'm actually going to be a guest on the Dividend Talk podcast, which is, I'm super excited about that. Ever since I've been investing, or when I first, from the time I first got into investing, the Dividend Talk podcast was one of the first resources that I, found out about in wanting to learn about this stuff. You go to YouTube, you check out podcasts, you read some stuff online. For me, from the very beginning, the Dividend Talk podcast has been like the dividend investing podcast, in my opinion. And so really cool full circle moment being able to be on their podcast tomorrow, or next week, excuse me. I'm excited for it. Sir Dude Bro Man, what's happening? Says it's been real sweet for him this week. Good. Let's see. Alejandro from San Francisco. Nice. Very nice. Alejandro, I'm originally from Sacramento, actually just a small town north of Sacramento. So Andres is here. What's up, Andres? Buying a fair amount of SCHD. Very nice. Fat is here. Hope I pronounced that right. Yeah, Patrick said this week, ouch for sure. Let's see who else we got. Tony's here. What's up, Tony? Picked up some SPY and ASML. Goodbyes. Nice. Let's see. I think I already said what's up to Andres. I'll say it again. What's up, Andres? Sparty's here. What's going on? Nice buys. Pepsi and J&J. Two really good looking stocks. Good move. Are you able to show us the allocation of your portfolio by sector? Absolutely. I'm going to save this one. We'll circle back to that. Salvatore, how was dinner last week? Delicious. And let me tell you guys, after this, I've got a fantastic dinner waiting for me. So, and it's leftovers from last night, but it's still really good. So last night, my wife made homemade pizza, just bought some like Trader Joe's dough and sauce and stuff like that, made really good homemade pizza, drizzled some balsamic glaze on top of it and some ghost pepper sauce, a little bit of chicken as well. So delicious. And we also, you guys are going to think we're crazy, we also went to Wingstop. And you guys know I added Wingstop to the watch list recently, so we had to do a little market research, but went to Wingstop and we got just 20 boneless wings and an order of fries. And yeah, so that's what I'm having for leftovers. I've got like 5 pieces of pizza waiting for me after this, and I think maybe 7 or 8 boneless wings. So that'll be good, and definitely need all those calories because tomorrow we've got a big run. Tomorrow we've got 30. I'm going to do like an unofficial half marathon tomorrow. I don't know if you guys know this. I've talked about it before. It's been a couple weeks, but I'm in the process of training for a half marathon here in Vegas. It's going to take place at the end of February. And every week I've been breaking up my runs into a few different types of runs. You've got your kind of like easy recovery runs, which is just very casual, very smooth, not too strenuous, you know. You've got your speed runs, which are exactly what they sound like. In some cases, it could be like sprint intervals, and those just really take it out of you. Not that long. You're maybe running for 20, 30 minutes, but you're pretty toast by the end of that. And then you've got your long runs, which are also exactly what they sound like. For me, over these weeks I've been training, every single week I've increased the distance of the long run by 1 mile every week. So, you know, a handful of weeks ago, I did 8 miles from a long run, week after 9, and then have worked up all the way to last week where I did 12 miles, which was killer. So tomorrow I'm going to do 13. And 13, well, I'll do 13.1 because that's the official distance of the half marathon. So I could use all the calories that I can get tonight. So anyway, tangent over. Let's keep going though. Oh, Zal, sorry to hear that you're sick, man. Good on you for getting that tea in though. That's helpful. Tea and honey. Oh, Striper says mix that Coke with some rum. That sounds good. I would if I had any. I've been pretty good on the alk for a while, actually. I'm going to Cabo next month though. Actually, the week of my half marathon, I'll be in Cabo with my family. So that'll be interesting. But anyway, I'm trying to be good until then, or as good as I can. So Dan the man in the building. Dan, I haven't seen you for a while, man. Happy New Year to you. Hope you're doing well. And yeah, glad to see you, man. Let's see. Mike is here sipping on a Pepsi. There we go. Brad Park. Hey, Brad, what's going on? Finally got to catch up with you. Yeah, happy to see you, my friend. Satya's here. Who else we got? Haas. Good to see you, Haas. Also picked up some Vici. So Pat. Okay, so this is in regards to Agree Realty. Stacking some cash plus the numbers never made me feel comfortable. Interesting. On the verge of being a yield trap. Because I always looked at ADC as being pretty solid in like revenue growth has been good. FFO growth has been good as well. So I'm kind of surprised by that. But yeah, got to do what you think is best. Let's see. Salvatore says it's all about AMD right now. Okay, there you go. All right. B Wayne. Wonder what the B stands for. Picked up some Blue Owl. Ooh, Salvatore sipping some chocolate milk. Very nice. Very nice. Phil's here. What's up, Phil? Picked up some SCHD. Adon is here as well. What's up, Adon? Nice. Evolution. Picked up some Vici. I'm seeing a lot of Vici buys, guys. Evolution did. Brad also did. Alejandra picked up some Vici. Nice. Yeah, a lot of good buys out there. It's definitely an interesting time for us dividend investors. We talk about this all the time. I'm certainly repeating myself in saying this, but you know, it's good. It's good to be able to buy these companies with higher starting yields. I was just looking at Vici today. Like the yield is officially back over 6%. J&J's yield right now is higher than it's been in a long time. Nike's yield, guys, if we go over to check this out. So Nike's yield is so far above the average right now. It's not even funny. If we scroll down, take a look at this, guys. So the average yield is about 1.1%. Right now, Nike's yield is sitting at 2.1%. So that's pretty crazy. I wonder what and really killer dividend growth stock. So, and I feel like this is, I've been getting a lot of questions about Nike lately, or just comments about Nike as well, saying how cheap it is, or, you know, if it's a generational buying opportunity. And I don't know whether or not that's true. I don't know, but it is certainly looking like a pretty sweet deal. far above average dividend yield, really great dividend growth stock. The dividend growth does appear to be slowing down, but, dividend's still pretty well covered. The payout ratio is kind of trickling up. While we're here, we might as well look at this. But even in the trailing 12 months, it's still only about 46%. So nothing to be concerned about. Free cash flow payout ratio is still very steady. Company's still buying back shares. Really nice returns on invested capital. On average, 17% over the last 5 years. So that's looking pretty solid. J&J, I wonder what their yield is looking like above the average right here. So same thing, the yield's getting pushed up to almost 3.5%, which is about 0.8% above the 5-year average. So that's pretty killer as well. We're not seeing as high of a dividend growth rate, but 5.4%, mid 3% yield. Hold on to that for an extended period of time, and yeah, should be pretty good. So interesting times, guys. Interesting times. Good time to buy, that's for sure. All right. And we'll see. I keep going off on these tangents. I've been talking about this more in recent videos, especially leading into this year. And I don't know what's going to happen next week. Next week could be a total reversal of what we saw this week. But it just seemed like something like this was bound to happen, right? I'm sure a lot of you guys were feeling this too. We've talked about this. It just seemed like things have been so good for so long in terms of the market going up that some sort of pullback, it wasn't going to be that hard to come by. Seems like just a small gust of wind could blow the market down. Okay. Yeah, Hershey's another one too. I'm looking at your comment, Patrick. Andy, nice time to buy some J&J. Start a position, I mean. Nice. Yeah, man's in the building. What's happening? Alan's here. What's up, Alan? Mauro's here as well. He's Portuguese living in Saudi Arabia. Nice. Well, happy to have you, my friend. Turab is here as well. What's up, Turab from New York? Oh, okay. So Jay, this is cool. 53 shares of Vici purchased today at $28 a share. Good job. Good job. Andy, first time in the stream. I'm about 10 minutes behind in the chat, guys. I'll get caught up. Yeah, seeing a lot of Vici buys. Andrew's here. What's up, Andrew? Julius wants me to bring back the wraps. I don't force it, man. If I feel a rhyme coming on, then I bust it. But otherwise, keep them locked up. But sometimes, sometimes they come to you like a spirit or something. Yes, Brad, thank you. Don't forget to join the Discord group, guys, and it's free to join. The Discord group is basically just one big group chat. I think there's somewhere between 3,400 and 3,500 investors in there right now. And there's a link to it in the description of the video. All you got to do is click the link, read the rules on the welcome page as soon as you join the Discord group, because that's going to tell you how to unlock all the rest of the channels. I think a lot of people miss that step or you get confused about it. But yeah, I'd love to see you in the Discord group. A lot of the characters that we see here in the live chat tonight, all the usual suspects who tune in, they're all in the Discord group. So it's a really fun place, really good community. And I'd love to see all you guys in there. Yeah, there you go. True. Very true. I was actually early, which is unusual for me. Bob's here. Lance is here. What's up, guys? Oh, there we go, Pat. This makes sense. Sold out of ABR, Arbor Realty Trust, not Agree Realty. This makes more sense. This makes more sense. So ABR, still a REIT, but it's a mortgage REIT. And I would agree that most, pretty much all mortgage REITs are like yield traps. Yeah. So, but ABR, to be fair, ABR has, out of all of the mortgage REITs, I think it's the only one I've seen with at least a decent track record of paying and growing the dividend. So I do think that they historically have been an exception to the MREIT rule. But yeah, I mean, if you don't feel good about it, if the same would have been true if it was ADC. If you don't feel good about it, you got to do what you think is best. So Dave's here. What's up, Dave? Happy New Year, man. Hope you're doing well. Nice buys with FICO and ASML. Very good. Very, very good. Yes, Sion says, have you checked out Evolution? I have. Yeah, Evolution is a beast of a company. Like perfect financials. So, yeah, that one's looking really good. Yeah, do market research with my taste buds, yeah. Whatever, tomato, tomato. For me, it's different names for the same thing. I mean, I like boneless wings. I like chicken nuggets. I call them what you want. I like them. Okay. Let's see. Dividend Doug, what is happening? Muted is here. What's up, Muted? Gabriel's here. What's up, Gabriel? All right. Let's keep going. Let's see. Wealth Shift. Do you have any real estate in Vegas? Currently living in Vegas as well. The only real estate I have here is the house I live in, my friend. Picked up this bad boy a few months ago. This is my only real estate here in Vegas. So Skulk is here. What's up, Skulk? Arjani's here. Yeah, hot honey. That sounds good. Matt, are you going to have a stout in Cabo? Probably no stouts, but I will certainly be throwing back a surplus of margaritas. That's for sure. It's going to be margarita madness. I'm excited. Going to drink a lot of margs. I'm going to read a ton. Yeah, it's going to be a nice week. I'm excited for it. And leading up to races like that, you kind of back off anyway. Like you really rest up. You don't do a whole lot of activity. I'll still get some workouts in and some light runs in on my trip. Nothing crazy though, saving that for the big day. So it'll be good. It'll be a good way to just relax, I guess, leading up to that. So let's see. Oh, that's cool. Jeff says he just flew into Denver for a ski competition. That's very cool. Very cool. Nice. Dalton hit 10K in the portfolio at 22. Congratulations. That's huge. Good job. Trevon, is Procter & Gamble good at these prices? We'll take a look at it. I haven't, we'll take a look at it. That's a good question. I haven't been buying. I haven't been thinking about buying at these prices, but we'll look at it, see where it is compared to some of the averages. So Lucas is here. What's up, Lucas? Drinking some red wine. Nice. And then I didn't even see Dan here's sipping bourbon and Pepsi with some vermouth. Man, that sounds really good. Jeez. Oh, Daniel, first timer from Sweden. It's 2 a.m. over there. Well, nice, man. Thank you for tuning in so late. Hope you enjoy this. Ooh, Gabe's got a good question. How to invest for a 25-year-old. So we will circle back to that one. Let's see. Ooh, Teeps is in the building. What's up, Jeff? How you doing, man? Ooh, Striper Kid, do you hold any Tractor Supply? I don't, but we'll take a look at that one. It's been a while since I've looked at Tractor Supply, but I hold that company in high regard. I think it's a great company. All right. So good. Can I look up ConocoPhillips? Yeah, we'll check that one out too. Keep the rap into PPC, Ian. The OG. Thug Life. I watched his well, let me ask you guys, did you guys watch his most recent video? I think he put it out yesterday. I don't think it was today. I think he put it out yesterday or 2 days ago, but did you guys check it out? Oh, there we go. Alan says, when I first joined the Discord server, I was lost and left and then joined again, finding out how to unlock everything. Well, I'm glad you found your way, my friend. You gotta read the rules. It should take you right to that welcome page, and it should, for any of you guys trying to join the Discord group, it should be front and center. Once you click the link, get into the Discord group, you'll land in the welcome page. All the rules are right there. It will tell you how to unlock the channel. You just got to read them or unlock the rest of the channels. So, Pat, this is from 5 minutes ago. I'm sorry, I'm just now seeing this. This week, Altria, thank you for the super chat, by the way. I really appreciate that. This week, Altria dividend put my lifetime dividends equals to 1 year, wow, of my wife's take-home pay. The spreadsheet helped get organized. Consider this super. Oh man, thank you so much. That's really cool, and congratulations. That's a really cool thing to measure. 1 year of wife's take-home pay. Nice, Patrick. If you don't mind me asking, how long did it take you to get to that point? How long have you been investing for? I'm curious to know. And I'm almost caught up in the chat, guys. I'm just a few minutes behind. German asks about Mondelez taking over the Hershey company. I don't think so. I don't know though. I really don't know. I'm not informed enough on it to have a serious opinion about it. Friendly Dick, are you still buying J&J, Realty Income, and Vici? I sure am. Bought some Vici today. Little Realty Income earlier this week. VDAX, VDADX. I have never heard of that, but we'll take a look at it. Let's see. Oh yeah, Dividend Doug asked about portfolio reviews. This is a quick one. We'll just answer this real quick. Yes, I do plan on doing more portfolio reviews. I'm going to kick it back up this week, or excuse me, I'm going to start them back up again this month. So you'll see a portfolio review video come out in the next couple of weeks. I just didn't do one in December. There were other videos that I ended up making instead. But yeah, we'll get back to it this month for sure. We'll also get back to doing like the monthly Q&A videos as well. So, Craig, dude. First of all, good to see you. Second of all, crazy. 6,000 shares, guys, of SCHD. Holy cow. Holy cow. Joey wants us to take a look at Medtronic. Absolutely. I haven't looked at that one for a while. So yeah, we'll take a look at that. Okay, so Patrick started January 2019. So you've been at it now 6 years. Wow. Well, yeah, I had to count. Man, that's crazy. That doesn't seem like, to reach that point, that doesn't seem like a whole lot of time. So great job. Great job. That's huge. Very cool. So Matt said, I'm not sure if you heard, but on Russ's Sunday show, I asked if me, Russ, and SCHD will do a SCHD. What is this? An SCHD reball trifecta spectacular. What is this? I'm missing something here. What is the reball trifecta spectacular? It sounds interesting, and I'm always down to do videos with Russ. So okay, guys, let's jump over to the, let's see, I see a question about OVBC and TSCO and MCO. What's MCO? We'll take, oops. Well, Moody's? Yeah, we can do that. That's kind of an interesting comparison, but we'll take a look at that. Okay, so I'm all caught up in the chat, guys, and looks like we have 9 really great questions saved. So for the next 30, 35 minutes, we'll try to bust through all of these questions. And yeah, we'll start with this one right here at the top from Be Still Sounds, who wants to see the allocation of my portfolio by sector. So I think the best way to do that, let's check it out over here on Snowball. Because I think it'll be easier to look at my total portfolio, including the ETFs. So let's go to portfolio. And by the way, guys, you can check out Snowball Analytics. There's a link to it in the description. Really like this portfolio tracker. But here's what we're looking at. So here is, I don't know if it's taking ETFs into consideration. Let's see. No, it's not. It's just looking at, well, I guess this is, right? Something changed on this pie chart. Funds, there we go. Okay. So ETFs make up 17.3% of the total portfolio. There it is right here. It was right in front of me. So yeah, here's the full breakdown. I mean, you can see it. You can see it all here. Consumer discretionary is my largest piece of the pie, and I have 3 different companies in this sector. I've got Starbucks, I've got Lowe's, and Williams Sonoma right here. And a lot of this is going to come from, well, I guess Starbucks is up there as well. It makes up more than Williams Sonoma. But one of the big reasons this is such a big piece of the pie is because Williams Sonoma has seen such a crazy return. So this would be much smaller if it weren't for Williams Sonoma. Industrials, the only company I have here is Snap-on. Energy, I have Chevron and EPD. Tech, I have Clear Secure. Consumer staples, I have Procter & Gamble and Altria. Financials, I have Visa, which you could argue also kind of dips into the tech sector. But Visa, which is now the largest individual position in the portfolio, which it's about time. Visa, Main Street, and Blue Owl Capital Corporation. Funds, we've got SCHD and VOO. Healthcare, J&J and AbbVie. Real estate, we've got Vici, KRC, Realty Income, and WP Carey. And then there's, I don't think there's even really any cash in there. I think that's kind of lagging. But yeah, that's the full breakdown of the portfolio at this point. Super easy. Let's see. Ooh, Fast Eddie. I'll put the pizza in the oven. The wings as well. I think that's the best way to warm it up. Okay. What else we got? Trevon. Good question. Is Procter & Gamble good at these prices? Let's take a look. Yeah, Main Street is very, very high. Main Street is super high right now. Okay, so we're looking at Procter & Gamble. Good question. Like I said, it's been a while since I've looked at Procter & Gamble. So you want to know if it's a good buy, you know, if it's at a decent valuation. In the last year, it's up 8%. I will say the free cash flow yield isn't too shabby, 4.25%. It's a little bit below, though, the 5-year average. So relatively speaking, based on these valuation metrics, it's doesn't seem to be at any discernible discount, at least compared to its 5-year average, excuse me. The dividend yield's pretty right in line with the average. So it seems to be about, you know, average price right now. Yeah, free cash flow yield's pretty spot on there with the average. Same with the price to free cash flow. PE's a little bit above the average. So yeah, it's not at a crazy discount. The yield right now is, like we said, it's about average, pretty spot on with the 5-year average actually. Look at this, guys. 18% average return on invested capital for Procter & Gamble. Not too shabby. Not too shabby. Real quick, I want to show you guys while we're over here. We just added financial statements to Snapstock. We're still fleshing it out a little bit. But not bad. Not bad for just adding it. Nice little go around, or nice first go around, I should say. And the cool thing is, if you click any of these right here, any of these years, it'll link to the 10K. Switching over to the quarterly view, same thing. It'll link to the 10Qs. So we can click that, take us to the, actually this one links to the 10K. So we need to work on that. But what's about this one? 10Q. So that one went to the 10Q. But yeah, very cool. And if you guys want to check out Snapstock, you can do so or learn more about it by clicking the link in the description. You get access to this when you become a member of the investment club. So if you want to check that out, once again, there's a link to it in the description. Really cool to see this thing continue to evolve. We're adding stuff to it all the time, and it's really coming along. It's been a fun project. But yeah, regarding Procter & Gamble, back to this, doesn't seem to be at any sort of crazy discount. Now, with that said, if you plan to hold on to it for, you know, the next 10, 15, 20 years and are just looking for like a stable, steady cash flower, dividend payer, probably not a bad one to consider, but I still think there are more attractively valued options out there right now in the consumer staples sector. This company's not entirely similar to Procter and Gamble, but same sector. I think Hershey Company is at a better discount. I think Mondelez is probably at a better discount. Those two really jump out to me right now. Pepsi as well. Outside of the consumer staples sector, J&J, if you're looking for a dividend king, J&J is, I think, much more of a discount than Procter and Gamble. Realty Income, and I know these are all different companies. I'm just trying to give some options of some different options of stocks that may be more attractively valued that are also like steady dividend payers. So, okay, I want to see what you guys have to. Oh, okay. Going back to SCHD. So, and Trevon, I hope that was helpful. I hope that was the answer you were looking for. Craig says about SCHD, I would love to do an SCHD spectacular with you and Russ at reconstitution time. Yeah, that would be cool. And that's in March. So yeah, a couple months. I'm totally on board with that. I think that'd be a lot of fun. Once it happens, we can just flesh out the changes and share thoughts and stuff like that, and have a nice little stream around it. I think that'd be a lot of fun. Yeah, and Matt, it looks like that's what you were trying to spell out too. I just couldn't I couldn't sound it out, you know what I mean? So yeah, BB, did you read The Income Factory? I did. It's right. You see where I'm pointing right there, that blue right there on my bookshelf? That's The Income Factory right there. It's been a while since I've read it. It's probably been 3 or 4 years, so I'm definitely due to revisit it and take notes on it. But I'll get around to it eventually. I've got quite a few books that I need to get to. So many books, guys. Good problem to have, though. So anyway, let's go on to this next question from Gabe, who says, as a 25-year-old starting out, would you recommend JEPQ, JEPI, or SCHD? Included in this portfolio is SCHG and VOO. Yeah, I mean, I don't know anything about your situation, your time horizon. I don't know anything like that, but I'm kind of defaulting to SCHD. I don't think JEPQ and JEPI are bad covered call ETFs. But generally speaking, I like to, these days I avoid covered call ETFs altogether. I feel much more comfortable just investing in just companies, whether directly or in a fund. And so, yeah, I'd say I'm more partial to SCHD than the other two. Okay, so Striper Kid, we're going to check out Tractor Supply now. And then while we're on the topic of Tractor Supply, we'll also get to Mike's comment here about comparing Tractor Supply to Moody's MCO. So we'll kind of kill two birds with one stone here. Obviously, we'll start with Tractor Supply, which, like I said, I'm a big fan of. Tractor Supply is similar to something like a Home Depot or a Lowe's, but it's also quite different. They sell. I mean, Tractor Supply is much more agriculture based. Like you can go to Tractor Supply and get like chicken feed and like chicks. I think even you can buy chickens there and stuff like that. So you won't find that at Home Depot or Lowe's. So Tractor Supply, it's similar, it's adjacent, but it's not entirely the same thing. So starting here real quick with the valuation, it does look to be, I mean, in the last year, it's up 24%, pretty in line with the S&P 500. PE ratio is 26.5. It's a pretty growthy company, as we'll see. So that might not be too bad, but this is also 17% above the average. The price to free cash flow is quite a bit above the 5-year average. I'm wondering if they saw a dip in free cash flow. We'll scroll down and take a look, and maybe that's why this is so high and above the average. Earnings yield and free cash flow yield are both pretty low. The free cash flow yield is, and once again, this could be a result of maybe a drop in free cash flow, but this is very low. So doesn't look to be at a super crazy discount. But interestingly, the dividend yield is 16% above the 5-year average. So that's very interesting. And I'm thinking, guys, just based on all this free cash flow stuff, I mean, the payout ratio is very high. I'm guessing we're going to see a drop in free cash flow here. So let's scroll down And sure enough, we see some negative free cash flow per share. I want to cross-reference this with Seeking Alpha real quick, because that's kind of surprising to me, because I only know Tractor Supply to be like a strong free cash flow growthy company. So maybe Snap stock is tripping. Maybe not though. Yeah, yeah, I guess so. See, this is showing a different chart, so I need to look into that. But oh, that's why it was showing the quarterly. Excuse me. There we go. So anyway, yeah, interesting. So not a crazy drop in free cash flow per share. Revenue and earnings per share look pretty good, right? Both double-digit 5-year growth rates. And this looks pretty good. I'm wondering why all of these free cash flow metrics are so low. The yield, price to free cash flow, and the payout ratio. I just wonder if it has anything to do with... That wouldn't make sense either. I don't know. That's really interesting to me. But generally speaking, Tractor Supply has been pretty solid grower, steady margins. The debt situation, according to this, looks a bit high in 2023. I don't know the trailing 12 months, but 2023, I mean, we can see that they're adding debt on a net basis. The net debt to free cash flow jumped up to 8. So that is a little bit high. But this is interesting. It's showing some really interesting stats here. Huge jump in the dividend between 2021 and 2022, about 77%, which is, we see that huge jump in the yield right here too. So interesting, very interesting. Free cash flow payout ratio is increasing. So I would keep an eye on this right here, guys. This to me does look a little bit concerning. It's getting up to about 90% in the trailing 12 months. This free cash flow situation is really tripping me up with this company. Really solid returns on invested capital, though. Looking at the 5-year and the 10-year, it's upper 20s. So I think that's looking really good. And based on that, it's no surprise to see this the returns just looking that good. Over the last 5 years, it's up over 200%. So it's done really well. So that's Tractor Supply. And now jumping over from the industrial sector to the financials, looking at Moody's. This will be interesting. Interesting comparison once again. So right off the bat, though, we're seeing a higher PE ratio, but a lower free cash flow payout ratio. Okay. And compared to the averages, none of this looks favorable. We're seeing a higher free cash flow yield, almost 3%, but this still does look to be on the low end. Low-ish starting dividend yield, 0.75%, below the 5-year average. Dividend looks to be very well covered. Very growthy, though. Very growthy. Very consistent growth. But the CAGRs aren't as high as what we saw with Tractor Supply. So Tractor Supply is growing at a faster rate. Moody's is more profitable. Not all too surprising, just given the nature of these two businesses. Much better debt situation. The net debt to free cash flow in 2023 was only 2.8 compared to Tractor Supply's 8. So that's nice. Yeah, dividend yield looks to be just dropping over time for sure. But they're still shelling out some nice double-digit dividend raises since 2018. Pretty much. Dividend looks to be very well covered. Solid returns on invested capital as well. Not as high as what we saw with Tractor Supply, but still over 20% on average over the last 5 and 10 years. That's, not going to complain about that. So I think both are looking pretty good, totally different businesses. So I don't know. I don't know. Let me see. I'm looking at just scrolling back up in the comments here, see what I missed, or in the chat. Ooh, Daniel asked about book recommendations. Oh, you were opening up a can of worms, my friend. Can of worms. Okay, Luis has a good question too about dividends now versus later. A lot of leases that count as debt. Okay, that's good to know. Mark's here. What's up, Mark? Okay, so let's jump over to Lucas's comment now about ConocoPhillips, ticker symbol COP. I don't think I've ever looked at this company before. No, I have. It's just been a while. Okay, so let's see, guys. That's not what we want. There we go, right there. Wow, look at that free cash flow yield. That's great. That's looking really good. Best one we've seen so far. Earnings yield is great too. Yeah, all of these valuation metrics look pretty strong. The dividend yield, and this is about average for this company, it looks like. Dividend yield is not too far off from the 5-year average. So based on this, I bet we're going to see some nice free cash flow growth. Yeah, for the most part we are, except for 2020. 2017 to the trailing 12 months was looking really good. 2020, obviously an anomaly year, negative earnings that year. But otherwise, I like these trajectories. The CAGRs are looking good too. 15.5% revenue, 9% earnings, 16% free cash flow. Yeah, so this is looking looking good. Margins are a bit all over the place. Margins are a bit all over the place, but that may not be too out of character for these cyclical energy companies, you know? Yeah, the debt situation doesn't appear to be too bad. In 2023, the net debt to free cash flow was 1.6. Interest coverage, which I should have looked at for the other companies, is 25.5 almost. So that's looking good. Dividend cut here. Is that what's going on? Did they reduce the dividend? Or is this probably was special dividends actually? Maybe special dividends in 2022 and 2023. That would be my guess. Special dividends in 2022. Yeah, this is looking pretty good though. Nice. Do any of you guys own this company, ConocoPhillips? I don't feel like I ever hear much about it. Let's see. A plateau dividend. Yeah. Right word, but close spelling. But yeah, I'm thinking there was a special dividend here. That's kind of what I'm thinking. Could be wrong. You guys might know more than I do. But anyway, Alejandro now wants us to look at VDADX. Okay, so I've never heard of this before. This is going to be a mutual fund. So let's VDADX. Okay, so let me go back over here. Yeah, Mark, no worries. No worries at all. Okay. Oh, no cash flow, obviously. Okay, so what is this? This is the Vanguard Dividend Appreciation Index Fund. Okay, so I mean, I like the idea of dividend appreciation. It's probably, if I had to guess, similar to something like a VIG, which would be the ETF version of something like this, if I had to guess. Yeah, nice top 10, 340 holdings. This looks solid. 1.7% yield, 9.7% dividend growth rate, 0.08 expense ratio. What's VIG? Is this going to be? Yeah, so pretty much the same thing, right? Same exact thing. So VIG is just the ETF version of VDADX or whatever it was. In which case, yeah, I think it looks good. I think it looks good. You know, Patrick, this is a great question. I don't entirely know. I don't actually know. It's something I've looked into before because I've wondered this as well. but I'm not at this point in time, I'm not sure what the key difference is. I do think one of the differences is the price, how frequently the price changes. I think mutual funds, you can update the price on, once a day or something like that. I think that's when it updates. ETFs, it's just like a stock where it's constant. Um, yeah, Jeff would know. I think Jeff would know here. Teeps would know. Blair says the difference is that mutual funds are more actively traded. Are they? Mutual funds are only trading once a day. Okay. Higher expense ratios than ETFs, takes aftermarket to settle the transaction. Okay. So yes, that makes sense. And that kind of goes along with, yeah, okay. That's kind of, I was kind of in line with that. Okay. Yeah, thank you guys. So now moving on to this next one, guys. Joey wants us to take a look at Medtronic. I'm happy you brought this one up, Joey, because it's been quite a while since I've looked at Medtronic. I remember back in the day, this was one of Ari's favorite companies. I don't remember when he sold it, but he used to be very hyped on Medtronic. So, okay, look at this, guys. PE ratio is 25% below the average. Price to free cash flow is almost the same. Earnings yield is almost 30% above the average. Free cash flow, the valuation metrics here are looking pretty good. Yield is quite a bit above the 5-year average too, coming in about 3.5%. So that's looking pretty good, I'd say. Decent growth, it's kind of spotty some years here. I don't know that this is entirely correct. I mean, just visually, the trend is up and to the right. We have some big years here, big jumps in the earnings per share that is throwing the CAGR off. And the same is true here with the free cash flow. But you can see just the general trend is growing. Probably, if I had to guess, the CAGR is really not too different than the revenue. It looks to be similar slopes, maybe a bit higher, maybe more like 4 to 5%. Margins, the gross margins do look to be coming down a bit. So that is something I would keep an eye on. Since 2019, they've gone from 70% to, almost 10% less than that. We're seeing it's not as clear because there are some peaks and valleys, but we're seeing, I think, generally a similar trend in the net margins and also in the free cash flow margins. So I would keep an eye on that. But still, I mean, just looking at the gross margin, still very high. Yeah, I would look at that. Debt seems to be creeping up, but still not in a bad spot. The net debt to free cash flows less than 5 in 2024. Interest coverage is about 8.6 in 2023. So that's not too bad. That's not too bad. It does look to be kind of deteriorating. The interest coverage does kind of look to be deteriorating over time. So maybe keep an eye on this. And obviously debt is increasing, which is not the end of the world. Still looks to be, serviceable for sure. Dividend growth looks pretty solid. 5% CAGR, 3.5% yield. This really is not all too different than what you'd find with Johnson and Johnson. And just based on the dividend stats, though, because they are so similar, I would probably me personally, I would opt for J&J, especially if we scroll back up to the debt and the profitability and the growth metrics. J&J is just much more consistent in all departments. So I personally would opt for J&J, and the payout ratios with J&J are a lot lower as well. So, and I think that's a totally fair comparison considering they're in the same sector, both make medical devices. So but yeah, thank you for asking about this one. Like I said, it's been a while since I've looked at Medtronic. I kind of forget about it. Okay. This is a good question. Alejandro, we'll circle back to this one. This is a great question though. Hova, what's happening? Hova. H to the is O, V to the is A. Okay. Steven wants us to look at OVBC. I've never heard of this company. Just truth be told, Stephen, I'm not going to be the best. I'm not going to be the best person to ask about this. This is Ohio Valley Bank Corporation. I truthfully, I don't know much about these types of companies. There's so many like Bank Corps, Huntington Bank Share. There's so many companies like this. I don't really pay much attention to them. I don't really quite understand how to look at them. So I tend to stay away from them. Um, so truth be told, I really don't have much to offer in terms of an analysis or any serious opinion on this company. And I'm sorry I couldn't offer more, but I didn't want to just spew some randomness at you. So, okay, so let's go to Daniel's question. Any book recommendations? Yes, sir. Okay, so, and I'm not going to go off on a huge tangent on this one. I've got some quick picks, actually. That's what I'll give you, some quick picks. And this is going to be tailored really for anyone who's just kind of getting into reading, wants to, read some good investing books. Number one, I think every investor needs to pick up a copy of Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark. Great book. It goes line item by item in how to read the financial statements. And I just think it's an essential read and resource for any investor, especially if you're investing in individual companies. I think it's a must buy, must own, and a good one to regularly refer to. That's number one. Number two is what I learned about investing from Darwin. I just finished reading this book not too long ago. It was one of the most recent books I read. And I've got to say, it's one of the best investing books I've ever read. And in a nutshell, the book compares investing or takes themes from evolutionary biology, Darwin, survival of the fittest, that type of stuff, and applies it to investing. There's a lot of symmetry between the two, and it's a really interesting book. So that's number two. Number three, I'd recommend Investing: The Last Liberal Art by Robert Hagstrom. That was another recent read of mine, and that book kind of touches on some of the same a little bit touches on some of the same ideas as what I learned about investing from Darwin. But basically, the Last Liberal Art book covers a handful of different topics from biology, like the Darwin book, biology, literature, history, math, all these different art, all these different subjects, and takes the main ideas, the main mental models from those and applies it to investing. So it's a good, it's a quick book to read too. It's only like 160 pages. But yeah, you get a lot out of that book. It's very jam-packed. Speak Life mentioned Psychology of Money. I think that's a great one too. Another book that I'd recommend, let me see. Richer, Wiser, Happier by William Green. That's another really good one. Oh, The Ownership Dividend by Daniel Paris. Any great read for any dividend investor. I actually read that one last time I was in Mexico. What else, guys? I've got a couple more for you. Income Factory is a good one. I'm missing one. Missing a couple. Investing for Growth by Terry Smith. I'd highly recommend that one too. And yeah, I'll probably leave it there for now. A lot of great books out there though. Yeah, Teeps, man, add that one to your list. You'll really like that book. Like I said, it's one of the best investing books I've ever read. Right now, guys, too, I said I wasn't going to turn this into a tangent. I promise you I won't. Right now, I'm reading The Creature from Jekyll Island, not necessarily related to investing, but it's about banking and the history of central banks here in the United States. It's actually pretty interesting. More of a history book than anything. Yeah, Lucas brought up Investing for Dummies. I actually, for Christmas, I got REITs, Investing in REITs for Dummies by Brad Thomas. Really excited to get that one or dive into that one. I also got for Christmas the Corporate Life Cycle by Aswath Damodaran, which I'm a little bit scared of. I've tried reading another one of his books. It was like the Little Book of Valuation, which should be an easy book to read, but it was just way over my head. He's He lays it on so thick. So I'm kind of nervous about getting into that book because I'm afraid it's going to be more of that same. But let's see. Mark, what do I think about the news out of Canada? I don't know. What news are you referring to? Oh yeah. Yeah, what news news are you talking about? Um Lucas, didn't you read the JP Morgan story? Yes, those are good too. So JP Morgan is The House of Morgan by Ron Chernow. That was a good book. That was a mission though. That was like, I don't remember how many pages it was, but it was certainly over like 700 or 800 pages. That was good. The Snowball I'd recommend. That's a great biography on Warren Buffett. So, yeah, Mark, truth be told, I don't really know. To answer your question about Canada, I not really paid attention to that. So I don't really know what the implications are. Okay, but let's keep going, guys. We've got 2 more questions to get to, and this next one comes from Luis, and I want to know your guys' thoughts on this too. This is a really great question for all of us, I think. Zal, yeah, I did mention the interpretation of financial statements. That was numero uno, my friend. But yeah, guys, I want to know your question. I want to know what you guys think about this right here. I want to know your answer to this. Luis wants to know, being at 20 years from retirement, so long time horizon, probably like a lot of us, would you consider it better to start a position and keep on contributing to SCHD for now, or move to it when it is time to retire? And this is an age-old question. Do I invest in dividend stocks now? Or do I invest in growth stocks now and then transition into dividend stocks later down the road? And I think I should save this question because I think it could be a good one. So here we go. And this might turn into a tangent. I'm going to apologize in advance, but I think the answer to this question can be complicated. I think there's a lot of gray area here, and I do think there are some trade-offs between these two, growth now and dividends later, or just starting with dividends now and cutting out the middleman. Just generally speaking, I won't even get to that. Yeah, Patrick, that would be an interesting conversation for the deep end. So let's kind of start with some of the pros and cons to each. So I think the good thing about starting with dividend stocks now is that, number one, you're already starting to build up that passive income stream. And I think that when it comes to determining when you can retire, I think it could be potentially a bit more straightforward to just take that approach and buy SCHD now. I think it could be more straightforward in helping you gauge how close you are to retirement, because retirement, or rather being work optional, which when I say retirement, I don't mean going and sitting on the beach. I mean the point at which work becomes optional. That is the point at which you can quote unquote retire. So that's kind of how I'm defining it. Reaching that point happens when the passive income that you're generating is equal to or more than the amount that you're making from your job. Once you reach that point, work then becomes optional at that point. So I think that dividends now, or I don't want to say prioritizing your passive income stream or prioritizing dividends, but taking more of that approach, I think could be more straightforward in helping you determine how close you are to reaching that ultimate retirement goal. So I do think that it is simple, it is straightforward, and it cuts out the middleman as well. So I think that's probably the biggest pro. And another pro, which would be a con for the other side, is that you don't have to worry about dealing with a big taxable event down the road. You know, if you bought into just something like the S&P 500, right? Let's say that you were, on the other hand, you were thinking, okay, well, it's SCHD or VU and then transition later. If you went to VU now, or the S&P 500, maybe you have to sell off your position, you're either all of it or some of it, to convert to a more dividend focused approach down the road. You know, upon doing so, you'll incur, assuming this is in a taxable account, you'll incur some sort of tax event down the road. So which when it comes to taxes, that's obviously one of the I don't even, I guess it's a downside, but it's one of the low hanging fruits for sure that the anti-dividend crowd likes to point to, understandably so. But it's either like, you're going to pay taxes either way. You either pay them now when you get the income, or pay the taxes later when you sell off your S&P 500 to convert to SCHD and then continue paying taxes there. So I think that's one of the big reasons why maybe people opt for an anti-dividend approach now and then switch later. That is, not dealing with taxes now. But on the other side, the trade-off on the other side of that, if you just want something more growth oriented or just S&P 500 oriented, there's a chance that you could see higher total returns or share price appreciation from doing that than you would investing in SCHD across the next 20 years or so. That's kind of the big trade-off, it seems like. Maybe that's the case. Based on history, that could be the case, but I don't know. None of us know what's going to happen moving forward. So, but I do think that that's kind of the big trade-off. But theoretically and potentially, it's like more growth today or dividends today, and then you swap them later. So, but then on the other hand of that, going back to SHD, kind of like Mike said, you might see less of a drawdown. If the market heads south for an extended period of time moving forward, you could see less of a drawdown with SHD. So, but yeah, kind of like I said at the start, there's a lot of gray area, and kind of like these guys were saying here in the chat, it doesn't have to be one or the other. I think that those two approaches complement each other very, very well. I think a lot of us do this. I do it in my Roth. I know a lot of us do this. You can have both. You can have some of your portfolio be in SCHD, some of it be in the S&P 500, or even like an SCHD SCHG combo. So I think that type of approach is very well balanced and really gives you the best of all worlds. And if you're not certain on the best route to take, then yeah, you can never go wrong with having some balance in your portfolio. And I think in the grand scheme of things across a long period of time, you're going to experience every type of market environment. And I think if that's true, I don't think you can go wrong with just having a generally well-balanced portfolio. So hopefully that makes sense. But that's a really good question. Very, very good question. It's always interesting to see the different responses too, because there's totally different schools of thought to this. Let's see. Okay, so that was a good question from Luis. This is the last one we have saved from Alejandro, which well, no, I guess it's not really the same. So going back to VDADX or VIG, the ETF version of that, would it be a good pair with SCHD? Kind of like a core dividend stocks to a dividend portfolio. Personally speaking, I don't think you need both of them. I think that one or the other I think they're both dividend focused funds. And because of that, I don't think you need one or the other. So I would choose one of the two. I think you could pair VDADX with like an S&P 500 fund or a more growth fund. Same thing with SCHD, kind of like we were talking about. I guess actually, now that I'm thinking about it, you do have companies like Apple and Microsoft and some of those in the VDADX. So it is a little bit different. So maybe it wouldn't be too bad, but yeah, maybe it would be fine. Dividend appreciation. But I think that's kind of what SHD is as well. It's a dividend growth fund. Let's look at what are things looking at in terms of share price returns between these two, or total returns even we can look at. So I want to look at, we'll just stick with VIG. Same thing, right? Okay. So it looks like you would have been better off going with the S&P. Yeah. Across the last 5 years. 10 years, they're pretty comparable, though. Yeah, I don't know. I'm a bit torn. VUG, SCHD, and VUG. VUG is growth, though, right? Yeah, growth index shares. So I personally think something like that would make more sense than like VUG with SCHD would make more sense than VIG with SCHD. Kind of like Hovo was saying. The experience, what's your take on Pool? I like Pool Corporation a lot. Let's take a look at it on Snapstock real quick. So Pool is actually on my it's on my watch list of stocks that I'm like somewhat interested in. And it's been there for a while. It's I got interested in Pool Corporation after spending some time with Watsco, which are similar companies. Pool Corporation is a distributor of pool supplies. Watsco is a distributor of HVAC supplies. Um, I really like the model of both of them. Pool Corporation, as a lot of you guys know, it's Buffett's one of his recent buys, and it's definitely come down in price. Last year, it's down 13.4%. So looking pretty good. The yield is quite a bit above the 5-year average. And this is a pretty growthy company too. Looking at these stats, revenue growth is almost 15% on average, earnings 20% on average, free cash flow per share is almost 34% on average over the last 5 years. And these 10-year CAGRs are looking great as well. Very steady margins, as we can see. And actually the net margins, if you look at the very bottom line, those generally have been increasing. These last couple of years, it's dipped back down, but 2014 to 2021 were really solid years for this company's profitability. Same thing with the free cash flow margin looking really good. Debt's not a huge issue at all. I mean, net debt to free cash flow 1.6, interest coverage 12.8. That's looking really good. Killer dividend growth stock. Not a bad starting yield, I would say, based considering this 5-year growth rate. The 5-year average yield 0.9%. Not exciting. I mean, 1.5's not too much better, but still just seeing it that far above the average is nice. And with these growth rates, it's looking really good. With that though, the dividend growth, well, I was going to say it has slowed down, but not really. Not really, actually. Historically, it's gotten faster over time, right? Over this last decade. If you look at the dividend growth rate over this last decade, for the most part, it's increased year after year. 2020 was an exception. 2023 and 2022 are exceptions as well compared to the previous years. But really nice trends in the dividend growth department and really solid return on invested capital. Over these last 10 years, there's the only time it's been below 20% is in the trailing 12 months. So yeah, I really like Pool Corporation. I think there's a lot to like about it. And if you are interested in that one, I'd recommend you check out Watsco as well. Watsco may not be, and I got to shout out Suzuki Man because this is like his Suzuki Man might have a Watsco tattoo. Actually, he likes it that much, and I wouldn't blame him. I mean, we can see very similar growth profile, very similar profitability profile. Margins are also steady and increasing. It's just very similar, and in fact, the net debt to free cash flow with Watsco is much more favorable. They actually have more free cash flow coming in every year than they do have debt on the balance sheet on a net basis. With that though, the dividend stats are a little bit different. The growth rate's a bit lower, still double digits over the last 5 years and 10 years, but the starting yield is a bit higher. Well, kind of actually. 2.3% in the trailing 12 months. Pool Corporation was 1.4%. So a little bit different there. I would honestly rather take the lower starting yield with almost 10% more, dividend growth rate. And right now, Watsco's yield is way below the average, so that is worth considering. Still, return on invested capital looks really good with this one too. So I think both great companies to consider. Okay. Let's see where we're at. Matt Money, what's up, man? Mr. Rocket Lab in the building. Mr. Airbnb. How's that going for you, man? It looks like from what I've seen, it looks like looks like it's been a really good thing for you. What else you guys got for me? We're a little bit past, about 10 minutes past the hour. But I think I got one or two, maybe one more good question here in me before dinner time. And yeah, do what Andrew says here. Hit that thumbs up button, guys. If you're enjoying this stream, I'd really appreciate it. Really appreciate the thumbs up there. So, and I hope you guys are enjoying this stream. 166 of us on a Friday night. I'm super stoked to have all you guys here. Thank you again for tuning in. Oh, nice. Yeah, went to look at a third house over the holidays, but wasn't feeling it. Nice. Nice, man. I'm glad to hear that everything's going well for you. Adam, what's for dinner? So you might have missed this earlier in the stream, but I'm having leftovers tonight. last night my wife made homemade pizza, and we also got Wingstop. So yeah, I'm gonna have some more of that tonight. So yeah, I know I kind of forgot about it. Forgot about dinner, to be honest with you. But yeah, I'm excited. Oh, good question from Doug. Alan's got a good question. Oh my gosh, Matt, you're funny, dude. Maybe a little both. I'm a blue steel. So Doug, what are your thoughts / plans on other asset classes outside of the market? So I do have some real estate. Actually just finished the rehab on my first fix and flip. So we'll see how that goes. I'm getting ready to put that back on the market. Do a little bit of real estate, certainly not as active with that as I am with stocks. But yeah, I don't have too crazy of plans outside of stocks and a little bit of real estate. Yeah, really don't have any crazy plans outside of those couple of things. So kind of a boring answer, I know. Alan, though, did you answer my question about the intelligent investor? No, I didn't see your question. We'll make this the last one right here. Question about the intelligent investor. Let me scroll up and find Alan's comment. Here we go. I was thinking of buying the intelligent investor. Is there a version that you would recommend? No, not really. You know, what's interesting. I think I probably owe it another. I think I probably owe it another read, but I don't know. The intelligent investor. I guess it's kind of like a rite of passage, right? Like you got to read it once, but it's not my favorite investing book. There's some good takeaways. But I've gotten so much more out of reading other books like Investing from Darwin, Investing for Growth, even Investing the Last Liberal Art. I think there's better investing books out there, but as far as versions, I don't know. I'm trying to look at what version I have. Let's see. I have, check it out. What do I have? I don't even know what version this is. First Collins Business Essentials Edition. I don't know that it says. Oh, 4th edition is what I have. I have the 4th edition, it says right on the inside. But yeah, and it's a thick book too. Like it's I'm in the appendixes now. It's over 500 pages. Yeah, it's about 520 pages or so. Sam, this is a good question. How do you handle taxes from all the dividends if you reinvest them? I mean, I make quarterly tax payments. And then like now I'll get an update once we figure out all the deductions and everything else, then I'll have to either pay a little bit more, don't pay any more, hopefully get some back. We'll see. But as far as handling taxes, if you reinvest them, I guess you would just pay it out of pocket, and if that's something that's concerning to you, then just to be safe, if you want, just don't reinvest all of your dividends. Maybe set aside like 20 or 30% of your dividends specifically for taxes, and then that kind of takes care of it. But, you know, I'm only bringing in, at this point, like, almost 3 grand per year in dividends, so it's not like a huge tax burden at this point. In the future, I'd be curious to hear from some of you guys how you do it, especially in this, like, you know, transitional period from now to retirement when as your income gets larger. What do you guys do? Or what have you done? Did you start setting aside some dividends specifically for taxes, or what did you do there? Yeah. Jeff, I agree with you right here. It was one of the first reads that I dug into. It was the one of the first books that I read when I started investing. And maybe this is why I think I owe it another visit, because I'm sure at that time a lot of it was over my head, but I remember it being very dry and very boring. And I think that the takeaways from it, like the main takeaway is just like the whole Mr. Market analogy. And I think the key takeaways from the book, maybe this is true about all books, I don't know. But I think the key takeaways from the Intelligent Investor you can get just from probably Googling it. And if you're going to spend time reading something like that, I think it's more worthwhile to read Warren Buffett's annual shareholder letters, which you can find for free online. So, Sam, I make quarterly payments based on my normal income. That's what my CPAs will every quarter. They'll send me an estimate that I need to pay to the IRS, and then we kind of adjust just based on what the entire picture ends up being at the end of the year. But that's not really related. It doesn't really account for my dividends. It also doesn't account for like deducting the tax or deducting the interest for my mortgage from my taxable income. There's a lot of stuff that's not included in that estimate of those quarterly payments that will then be taken into account now at the end of the year as we wrap things up. And my wife and I, this will be our first year doing it, but my wife and I now will be filing jointly. So it also doesn't take into account her income and stuff like that. So there's just a lot. Adam, that's funny. There's just a lot that that's not taken into account with those quarterly estimates. Truth be told, I'm not quite sure I'm following the reasoning behind this. Oh, I think I get it. It's like in a savings account, like Zal said. So basically, the money that could go to taxes, instead, like, set it aside, but put it in something like JEPQ that will generate some return. I think that's you could do that just as well. But I don't know. It seems to me that's just I don't know. It's too much of a it's not worth I don't even want to call it a hassle, but it's just not worth it. I don't feel like I need to game it that much. It's not, to me, it's not like that a huge ordeal. But anyway, guys, almost an hour and a half. I think this is a pretty good place to wrap up the stream. But yeah, I think this is a pretty good place to wrap up the stream. And with that, I want to thank you guys for hanging out with me this last hour and a half. This was fun. This was a good stream. First time in a while that we've done been on the normal schedule here. Nathan, what's up, man? Nathan, you've been here this whole time? Been hiding, man. I haven't seen you in the chat. But yeah, all of you guys have a great weekend. Thank you to our lovely moderators, the very great and talented Zal, the almighty Chris, and Matt, the magic man. Thank you guys all. Yeah, I'm shy. Thank you guys all for your help tonight. I don't think we had any trolls, unless I just didn't see them. So, yeah, thank you guys all once again for all of all the time. And I hope you guys have a great weekend. Let's see what the market brings next week. Real quick, before we go, what do you guys think? Are we going to have some more red next week? Are we going to have some green? Is it going to be a reversal of this week? I know no one knows. No one's got a crystal ball, but just, what do you think? What's going to happen next week? Green or red? What do you think? Striper says more red. More red from Zal. Nieces and nephews says red. Yeah, all of you guys are saying red. Patrick, yeah. There you go. Doesn't matter. Yep. There we go. You guys have got your head on straight, that's for sure. Steven says green. Wow, okay. Red until they say rate cuts. Yeah. Sir Dude Bro Man wants a sea of red. Yeah. I'm kind of thinking that too. I would not be surprised if we see some more red. So it'll be interesting though, that's for sure. Red is good. Can get more bargains. Absolutely. That's what it's all about. As net buyers of stocks, it's good to be able to buy them for cheaper. So we'll see what it brings, guys. But yeah, in the meantime, I hope you guys all have a fantastic weekend. You know what? Last thing before I go, be sure to tune into Sunday's video. I'm going to be revealing my wife's dividend portfolio for the first time ever. We're bringing that bad boy back to life. I don't think I've ever shown it or talked about it really. So Sunday's video is going to be all about that. And yeah, I'm looking forward to getting into it with you guys. So be sure to check that out. But otherwise, I hope you guys have a fantastic weekend. Stay safe out there, and I'll see you in the next one.